Welcome to Security Token Stories, brought to you by Security Token Academy, the leading educational platform dedicated to covering and facilitating the security token industry. I'm Derek Edward Schloss, Director of Strategy at Security Token Academy. Dan Doney is the CEO of Securrency, a security token firm focused on enhancing financial infrastructure by building and deploying blockchain-based technology that unlocks efficiencies and interoperability across the world's asset markets. In this episode, Dan and I talk about COVID-19's influence on the decentralized finance space. We also cover the mapping of security token technology to DeFi in the future, WidsomTree's strategic investment in Securrency's $17 million Series A earlier this year, and why security tokens may eventually disrupt the ETF model. Finally, Dan and I touch on the implications of the recent pandemic to the security token industry, and whether this may help speed up or slow down the inevitable shift to a tokenized future. Dan's been building security token technology for just about as long as anyone. It's a great episode, and he speaks eloquently on a number of excellent topics. I hope you enjoy this episode. Dan, welcome to Security Token Stories.
Hey, Derek, how you doing?
I'm doing well, holding up. We're recording this episode in mid-March, and I have to say these are certainly interesting times. Before we we can actually include some of the blockchain stuff. But before we deep dive into Securrency, I have to ask, how are you holding up? How is the Securrency team holding up? And how are you thinking about the markets, the blockchain space? We've been on a wild ride for the last week, and it feels like we're just kind of getting started.
Yeah, in case anyone's listening to this a way down the road, this has been just a completely black week as the coronavirus is, the implications are being recognized across the world. The markets have crashed with this and the crisis in oil, and not just the traditional markets, but also the crypto markets, and in very significant ways. These are testing the baseline assumptions that many folks make with respect to markets, and it shows how delicate all of these things can be, how important regulation is in the end, as in terms of maintaining proper liquidity in markets. Among the incidents, there's currently a crisis with the DAI, and making sure that it is properly funded.
Dan, I'd love to hear your take. You're bringing it up with, maybe a quick primer on Ethereum and Maker and DAI and that system, and kind of some of the problems that have happened in the last day or so.
Yeah, this is a general challenge associated with DeFi, and it comes down to the rehypothecation of assets. So rehypothecation works like this. It's been around for a long time in terms of a process. If I go to a bank and I deposit my US dollars, so I'm handing someone physical US dollars, the bank puts it on their ledger as a custodian. And so they say, I owe you, if I deposit 10 US dollars, I owe you 10 US dollars. And so on what is used to be paper, but now electronic and hopefully soon distributed ledger record, it's stored that I am owed $10. And then I can do things with it. And really the bank is then giving someone else access to my $10 if I engage in a financial payment. But in fact, the bank doesn't just sit there with the $10 in their vault. They take and lend against those dollars. So that lending against a deposit is known as rehypothecation. So my balance says I have $10, but in fact, if I were to come back and there was only me and say, give me my $10 back, once those dollars have been loaned out, they don't exist there immediately. So if I took them all and it was only my dollars that were in the bank and they had loaned those out, they would not be able to give me back the dollars that I had deposited. And but this, by the way, was the problem for the banking industry prior to the 1930s, when the depository insurance came online, certain requirements regarding minimum deposits that needed to be held by the banks. It used to be in 1920 that if you saw 2 or 3 people lining up in front of your bank, you better be the next in line. because it meant a run on a bank was occurring. And, unfortunately for the folks who weren't quick about their business and get to the bank in time, there'd be no dollars left by the time they got there. And these runs on banks were routine, but every 10 years, you'd see a run. And so it was common. Now, since the 1930s, we haven't seen a run, and this is largely because the industry is regulated with specific liquidity tools in place to ensure that banks can only loan so much against their deposits, so that unless everybody is looking to check out at the same time, you won't run into this problem. And there's complete transparency in terms of, well, there is transparency. I shouldn't say complete transparency. Blockchain can do this much better, but investors can see, and banks are required to report exactly how much they're holding against their obligations. And most importantly, the Federal Reserve with the overnight rates are designed to allow banks to borrow one from another to meet their obligations overnight. Now, with the DeFi industry, there is no such limit. So you're able to get, for example, 8% interest in some cases on US dollar deposits. You have to ask yourself, where's that coming from in this? And it comes from, there are a few reasons for it, but these are, there is substantial rehypothecation of the deposits that are made. And so this is the case where you run into the problem that if everyone comes and makes a call on these, you can run into a big issue in the market. And there's no oversight in terms of how much your USDC, for example, is being rehypothecated in the industry. And so in the absence of these kinds of things, you run into dangerous possibilities. It's the very thing that blockchain can solve, because you can get complete transparency, but it's not being used. And there's no one who's overseeing it to make sure that we have this kind of transparency in the marketplace. Now, there are other models in terms of, like, for example, the way that the DAI works, where you have a basket of currencies that is really allowing the asset to be pegged, for example, to the US dollar. That anyone who's doing asset management behind, in order to peg an instrument, is engaging in an asset management function for which there are, in the securities world, reporting requirements. And those reporting requirements are there for good reason. People need to understand exactly what's happening with the assets that are being managed in any way. And so this is why things like Libra in its original form and other tokens that have come along, doesn't matter that they're pegged to the US dollar or in some way linked to the US dollar. What matters is what happens behind the scenes to make that possible is a regulated function. It's a thing where investors need to be protected against abuse. They just need to know what's happening. And so as a result, when folks had, for a while sort of complained, well, why would the SEC see these things as securities? Because now we're finding out why, in terms of the existing market conditions. Now, it is a different matter when something is directly pegged and not rehypothecated. So if I deposit $1 and someone issues me a dollar issued IOU, which without lending is simply a custody function, that's a different regulatory framework in this. So hopefully folks are learning some important lessons in this. These are the kinds of things that Securrency is built for. So these are the kinds of times where the models that we've put in place to protect against these things start to shine. But it's unfortunate that you have to wait until these times when people learn the hard way that the industry rules are there for a good reason.
We're going to jump into the tools, some of the tools Securrency has built. I specifically want to talk about some of the compliance-aware token framework that you've built, along with some of the identity solutions that you've built. But before we do, I'm curious, do you envision a world one day where Securrency is really operating within the DeFi framework? I know these two worlds have really been siloed and kind of segregated out to date. But with kind of what's happening this week, and just listening to you talk, Dan, it almost feels like these two worlds will start to coalesce and intermingle more quickly now. I just don't know, if that. I know that the ethos of the DeFi spirit has really been different than what I think a lot of the folks in the security token industry have been building for. But these worlds, in many ways, are kind of umbrellaed by a legal layer, and at some point, I think these two things will kind of mix together. I'm curious how you think about that.
Yeah, so we do, and I've often thought that lending is the real killer app for blockchain. It's the place, and particularly securitization, securitized lending, is the future of this industry. I think actually even in the short run, but especially over the long run. And here's why I say that. So I do believe these things will come together in important ways, but it's important, just as I think the blockchain industry has learned a lesson that, hey, you shouldn't ignore compliance. They should also similarly in the DeFi model not think that asset management and asset management responsibilities can be ignored. That the existing rules which govern these things are, again, there for a specific reason. Now, here's the good news for everyone involved. DeFi is right. It is substantial. This is the direction things should go. I've written about this in the past. There's articles out there about how the 2008 collapse occurred. This was largely due to lack of transparency, the same lack of transparency that I'm sort of criticizing the DeFi industry for in this case was rampant in 2008 with residential mortgage-backed securities. But here's the good news for everyone. Blockchain offers full transparency if it's used properly. Unprecedented transparency. You can't cook the books. And so this, again, is the big, we believe, fully transparent, full self-processing loans in full self-processing securitized pools are the future. That's where you can get yield. That's where you can get easy access to liquid capital. That's where this is going. And it can avoid the problems that led to the 2008 financial crisis because you have fully, instantly reporting, completely transparent models for how these things run. We believe the industry will go there. And we believe we have the tools to help the industry go there. So we're excited about the future. The old way, the old models cannot be transparent at the scale that's needed. 2008 was a demonstration of that. But new models, which don't expose this kind of data, are not better. And so let's make the better models, the ones that do expose, for example, the extent to which you have your assets covered, that allow an investor to actually see exactly what's happened with the value that they've deposited or that they have invested.
Dan, tell me if I have this right, but it feels to me like you're advocating for public permissionless networks and for really that sovereignty over the asset, that sovereignty over the contract as an individual to be able to have with these public permissionless systems. Is that right? Are you saying that correct? Am I understanding this correctly? And also, assuming that is the future, what kind of role, looking back over this last week, do you think Securrency could have played in preventing some of the incidents that have happened in DeFi?
Yeah. So, great questions. Let me unpack these in reverse order. So, the first question is really how would we work with DeFi? We've actually got a token strategy. We built a framework that allows effectively tokens to be assets to be embedded into a fund structure that is self-reporting. The assets can really be any kind of assets. They can be loans. They can be treasuries, is the case that what we're looking for WidsomTree in directions that they're going, or any other. It could be equities. It can actually be interest in other funds. Those can be. We've got a nested structure which allows for self-reporting in that model, such that if you've made a deposit into a DeFi if you're earning DeFi interest, you are effectively a shareholder in the overall DeFi structure, and you can see as a shareholder what is being done with your deposits and exactly how much is covered. So we have those structures, and those are things we haven't published those broadly into the market, but you're going to see a lot because we're about to begin showcasing those models, and those can be used for DeFi. Okay, so more on that. Let's do another session in 3 to 6 months, and we'll actually walk through specifically those tools because we intend to open source them for other folks to use broadly. Now, of course, transaction logic, as you know, Securrency has built a pretty powerful framework. We're going to go into this, I suppose, a little bit more here a little bit later. For transaction logic associated with any instrument of value, whether that's a securitized pool of DeFi loans, it's an individual loan, it's equity in a startup, or it's a publicly traded share. We have the ability to create the policy, attach the policy to the token that governs it under its regulatory framework, anywhere in any regulatory jurisdiction that's been mapped into this framework, and the token knows what it's allowed to do, and it ensures that the transactions that occur with the asset are legal. And they can have other rules as well where, for example, you prevent a loan that would cause you to fall below your required reserve, et cetera. So it's a generic policy engine that allows you to create and maintain policies that govern smart contracts in terms of the way they behave. So a lot of what we've done applies in this and any other industry in terms of our policy engine. Okay, now there's the question about public and private ledgers, and we are big advocates for public ledgers because the benefits, the true benefits of blockchain, that really comes down to distributed authority. That's the whole, DeFi is really built on that. And second, consensus immutability. But if you're using some sort of private network, you're really not taking full advantage of consensus immutability. So we believe that public networks are better than private networks. There can be reasons why you would want to do a private network, and our system works with private networks, so we don't have a dog in the fight. We just think that the general principles of blockchain would have you want to move to public ledgers preferentially. So we see that. Now, the other piece of this is you can do privacy on public ledgers using zero-knowledge proofs. And so you can gain the benefits of privacy of private ledgers on public ledgers and execute transactions. And what's more, with the right tooling, and again, there are very, very few parties in the space who can do this, you can have the privacy, proper regulatory oversight, so that is people who have a need to know, whether it's shareholders or regulators, can see what they need to see regarding transactions and can be held accountable because you now know what they've seen. So effectively, this allows you to regulate the regulators. So we think it's a very exciting model. We think that public networks, public ledgers are the correct way to do, the best way, I should say. There are reasons why you may want to go with private ledgers. We think that's all cool. But let's try and do this as a community on public blockchains.
That's great. Dan, gotta ask about the news from January. So the WidsomTree deal, the asset management giant and pioneer of ETFs and ETPs, announced a strategic investment as part of your Series A, your 17 million Series A round. This was a pretty big deal for a lot of folks in the security token industry. It's a giant stamp of approval for blockchain-based securities and the upgrades that you're mentioning blockchain can bring to the world of finance and securities and trading and ownership. Dan, honestly, it would be great to start off here just hearing a bit of background on ETFs generally, what they are, their context against the mutual fund industry over the last 20, 30 years, and maybe a bit about why WidsomTree is looking to Securrency and security tokens and blockchains as a way to kind of bring new innovation to the ETF space.
Yeah, so the exchange-traded fund industry has disrupted the mutual fund industry. It's not that mutual funds are gone, but they're going away. And to yesterday's events actually are a great example of why that's true. So I've got a bunch of my retirement money in a mutual fund, And seeing the market action, I decided, and some of it in very safe investments, I decided now is the time to get in. But with those funds, I can't really get in until the end of the next day. Well, today, there's a substantial rally. I'm missing out on all that. Even
we're spoiled. We're spoiled in the blockchain space, Dan.
Yeah, that's right. And so you don't have the ability with the mutual fund world, just based on its structure, to get in via an immediate transaction on an exchange. And so it is. Exchange traded funds have a better structure. They have better tax advantages, better asset management structures, lower fees typically. So it's a better model. And John O. Steinberg, the CEO of WidsomTree, saw that early on. He saw where this was going in terms that it was time to get in. Now, his background before that, he was in media, and they produced indexes for the purpose of informing investors who might want to be tracking what's going on in foreign currencies, emerging market currencies, among other things, right? So if you want to build your strategy around this, you kind of want some kind of indicator that's not specific to an individual asset, that is tied to an industry. And so they developed really clever indexes along these lines, and they realized, we could actually turn those indexes into funds. And John laid out, they've just got a spectacular brand and really cool funds. They just released one for batteries, I saw a couple weeks ago. That's clever. That's a very important industry, obviously, according to the future of these markets. And what they saw in blockchain was what ETFs did to mutual funds. They saw a better systematic structure. So the back end of mutual fund management and exchange traded fund management are a bunch of manual processes that have reconciliation between parties. It's a mess. I can say, having seen it now firsthand, it's not efficient. It's efficient at massive scale, efficient enough at massive scale, but not efficient enough to allow real-time transactions to occur. Real-time in terms of the asset management functions associated with the running of those funds. And it doesn't provide transparency in terms of the trading structure. If you want to go into new asset classes, it can be challenging, et cetera. They saw that blockchain could solve those problems. Now, what they needed as a marquee brand with an institutional credibility is to have a full compliance capability. And so they looked across the industry and they didn't see those tools outside of our platform. And so that we came together, went through a long dating process with a lot of due diligence on what we've got. And ultimately, they decided to lead our investment round. They are visionaries. So they see where this is going. They are really strong supporters of the blockchain model, but it raises an interesting question, one that I frequently get. So their assets, WidsomTree assets, are among the most liquid in the world. They have funds that trade at tens of millions of dollars a day, and more, and so they begin to take on the ability to support transfers, that is, exchanges, movement through value, that frankly would substantially move markets in the crypto world. But they can support based on the liquidity of their assets. So the fantastic model, since their assets are so liquid, what's the benefit of tokenization? I often get asked. And so people have pushed into the market that the benefit of blockchain is liquidity. And I believe that's true. That I am, not only do I believe, I'm certain that that's true eventually. But there are other benefits of blockchain. And this is the thing that the industry is assuming liquidity is going to appear out of nowhere. It doesn't. The first thing you need to have is stable and liquid assets in the space. Liquidity begets liquidity. So when you have activity and things that support large volume, it can support then large volume with other assets. So the space hasn't had assets like what WidsomTree has. But the benefits to WidsomTree, when you have the compliance capabilities that we have based on our compliance-aware token framework, that allow you to sell into markets in Asia, in the Middle East, in Europe, and not just in US-centric markets, or WidsomTree has a European presence, but you can sell beyond the jurisdiction that the asset is issued in. That opens up new distribution. So you can begin to have the possibility of truly global assets. And that's exciting, even for them, because of course, asset managers like WidsomTree make their money based on assets under management. And the bigger the distribution, the more assets you can have under management. The second benefit I alluded to earlier, that is efficient back office operations. So the whole asset management industry is experiencing fee compression, meaning they can charge less and less to run a fund than you used to be able to. The investors rightly expect that there's very little friction associated with their investments in terms of the fund management responsibility. But that means your system has to be able to do self-reporting, automated transactions, and transactions that actually reconcile across a large number of parties. And you can see how blockchain begins to have a benefit. Things like paying a dividend are trivial in the blockchain space, whereas in the traditional world, there's much more involved and a lot more reconciliation and settlement that needs to be done. So you can change the cost structure associated with fund management. And that's why we're excited to work with them.
Yeah, that's great. I'm looking at my notes right now, Dan. So tell me if I've got this right. So, mutual funds were sort of disrupted by ETFs because ETFs were more efficient. They had a kind of a lower cost structure, and now blockchains are kind of disrupting this because they are, significantly more efficient, and they also have this global reach. You're no longer hampered by kind of these jurisdictions, right? If you can build compliance into this tooling like Securrency has done, you basically expand the distribution of these instruments. Do I have that right?
Yeah, so broader distribution, efficient transactions, of course, with instant settlement that you get. So blockchain funds, blockchain-based funds. Now, I want to make this clear in case it's not clear to the audience. We're not talking about an exchange-traded fund of Bitcoin, a Bitcoin ETF. What we're talking about is tokenized versions of existing, let's say, an energy fund or a treasuries fund. Tokenizing those instruments allow you to reach a global audience, and second, and maintain compliance as you reach a global audience. And second, the actual fund management functions over time can be fully automated so that the cost structure associated with running the fund is less. And of course, that means investors' money is being put fully to work and not paying management fees.
Yeah. So the thing I think about most, Dan, when I think about just operating in so many jurisdictions are, we alluded to this earlier in our conversation, but there is this legal layer that overhangs everything in the financial services industry and financial assets. A lot of it stems from things like identity. A lot of this stuff stems from kind of just the differentiated regulations that map across all of these jurisdictions. And so when I hear about kind of the global benefits and distribution of these assets, the thing that kind of the alarm bells that go off for me are, man, that is a lot of work to kind of figure out how all of this stuff can map to these protocols or the tech that you guys are building. So I'd love to hear about some of the regulatory hurdles that you're thinking about around this, Dan. And I know you're fairly involved. You've got to be with regulators all the time. You have to have probably a very strong working relationship with them. I think that's super important for something like the security token industry to develop. I guess I'm curious to hear, how do you think regulators are thinking about things like security tokens, technology like the stuff that Securrency is building, blockchains as a settlement layer, just all of this stuff? I'm curious to hear your take.
Yeah, so here, this might be a surprise to listeners. Regulators are good people. They actually care about the markets that they're protecting, of course. This isn't a surprise for seasoned individuals. They're good folks, and they both mean well, and they are much more sophisticated, I think, than many people give them credit for. Now, we are working with them in regulators from many different jurisdictions, and developing specifically frameworks. We're excited. There's an experiment that's sort of shaping up with a number of regulators from different jurisdictions who will oversee cross-border trading, leveraging the compliance aware token framework in this policy engine component I'll go into here in a minute. But it is hard. So your observation is correct. It has been massively hard. We thought when I kicked all of this off in 2015 that we could handle the compliance layer in about 6 months' time. I was wrong. It took about 4 years to address all of the challenges associated with this. But the good news is, in our framework, this is something that people don't have to do. So I was recently in a debate with one of the providers in the space who said, I can take US Reg D and I can have a junior developer build that into my smart contract. And so why do we need a sophisticated model for transaction policy when I could do that? Well, if you expect your developer to hard code into your contract all of that same junior developer, all of the global regulations for all asset classes, everything that your token might actually encounter, you're going to get yourself into serious trouble. And not only that, if that coding can't change as regulatory policy changes, your tokens are going to be irrelevant almost the day after they're issued. We know that the SEC's put out a proposed rule change. The U.S. regs will change here in the near future. So what you need is a framework that can adapt to changes in global securities regulations. What we've done, and let me summarize this quickly because I know we're already running longer than our 30-minute target, is I'll summarize it this way. It's important to separate regulatory authorization from simple transaction logic, such that you can build rule sets, policies, we call them recipes, separate from the inner workings of the token itself. And so that when a transfer request is made via the token on, say, an ERC-20 standard transfer, it then consults with a much more sophisticated policy, which knows what the token is allowed to do. So we do it this way. We are able to capture and map the securities regulations from different countries. Take the US. There's a number of different regulatory frameworks, A+, D, CF, and other things like Rule 144, that actually each one of those is itself a fairly small and simple set of rules. You can sort of combine each one of those into its own recipe, combine those together as a recipe that says, hey, if this is trading under U.S. jurisdiction between U.S. entities, then the following rule sets apply. So recipes can include other recipes, and you can have effectively a recipe that considers all jurisdictions as a higher level recipe, or you can just build small recipes that are, for example, the Australian securities regulations. We do that. Those are then, we have a simple editor. It makes it easy. We joke that even lawyers can use it to build out these rule sets. Those get published as bytecode, which we have an on-chain interpreter, which then interprets the policy at transaction time and determines whether or not the transaction is legitimate. If the policy changes, you simply update the recipe, you publish it, and the policy then is updated in terms of the way that token behaves. Tokens have attributes, they fall under a regulatory policy, so it knows, the tokens know, in a very simple way. And again, what this means is anyone who develops a token doesn't have to know all the securities regulations. Our policy engine does. And this is an open framework that we hope that others in the security token space will freely use to enable them so that we can build out these recipes a couple times, once, share them broadly, and people can not have to be worldwide securities experts knowing every jurisdiction's laws every time they build a token.
Dan, I love the analogy to coding in these regulations and these component parts as recipes. It's I'm gonna have to start calling you Dan, the security token chef, because I think that's a great way to look at it. We're running out of time, Dan, but I have to ask. We got to close it out this way. We are in the middle of a pretty significant period of economic history right now. There's a lot happening, and I think COVID-19 is kind of helping expedite and kind of bring to light some of the problems just across the world. And I'm curious how some of the setbacks we're seeing this week and will likely face over the next couple of months, how does this affect the stuff that you think about every day, the things that you're working on in the blockchain space with tokenization, distributed ledgers, and institutions? Does this, do events like this eventually speed things toward a tokenized future to really net some of the benefits that we've talked about? So things like efficiency and transparency and cost savings, or do you think it sets things back? I gotta ask, I gotta hear your opinion since you're so close to this.
Yeah, so I do. Unfortunately, it seems to set things back because people they paint a broad brush across the entire industry. But the sad thing is that's actually killing the very thing that can save us. So I've written about this regularly, starting in 2015, that a liquidity crisis would come again. And that we hadn't actually addressed the problems of 2008. In fact, in many ways, the steps were taken in 2008 to fix 2008, make it worse and more likely to happen at a bigger scale in the future. Security tokens are the answer, period. Models that are transparent, make it easy to price assets, make it easy to trade at global scale, minimize the too big to fail kind of offerings that have to go through the world's financial centers, and allow for a lot more diversification in the kind of financial instruments that are out there, are the only way that we prevent a global financial crisis sometime in the future. And we may be at the start of it here now. I don't believe this is the one. But people listening to this 4 weeks from now may see this in a very different light. But there will be one that's coming if we don't fix the core financial model. The core financial model can be fixed by blockchain. It is better than the predecessor and the traditional models. We must take this process seriously, and it's driving us. We believe that this will help prevent the kind of disaster that my kids are going to run into at some point if this doesn't become widespread. But, I would caution folks on the blockchain side, quit goofing around, quit ignoring regulations or trying to get around it or thinking they're silly. Take it seriously because you do have the answer once you realize how this fits into a bigger framework. We can prevent, if we work together and do the right things, a global financial collapse.
Yeah, very well said, Dan. I really enjoyed this conversation. We covered a lot of ground, and I loved hearing how you're thinking about the blockchain space more broadly and the security token space more specifically, and the work you're doing at Securrency and with WidsomTree to kind of move toward this future. It's super exciting. Dan, where can people find you online? Where can they learn more about the things you're working on? Where can folks reach you if they'd like to learn more?
Yeah, always www.securrency.com. Securrency.com, that's SE and currency.com, securrency.com. So always check it out there. You can follow me on LinkedIn at Dan Doney there, and trace us at various conferences here and there, and keep an eye out as we release the WidsomTree offering once we get through SEC approval.
Awesome. Well, thanks for your time today, Dan.
Thank you, Derek.
That's it for this week's episode of Security Token Stories. For more security token content, visit us online at securitytokenacademy.com and subscribe to our newsletter, The Security Token Edge, which lands in your mailbox each weekend. You can also keep up with the latest security token news by following us on Twitter, Telegram, YouTube, Facebook, and Medium. Before we go, a big thank you to Security Token Academy's Platinum and Gold corporate members who make this podcast possible. You can learn more about Security Token Academy's corporate members at securitytokenacademy.com. I'm Derek Edward Schloss. From all of us here at Security Token Academy, thanks for listening.
Security Token Academy does not provide investment or legal advice. We are not a registered broker-dealer or investment advisor. Opinions expressed in this podcast are the speaker's own and do not necessarily reflect the views of Security Token Academy. More information can be found on our website at securitytokenacademy.com.